Over the past few years, we have seen news media left and right saying that Western investors, specifically American investors, are leaving China after decades of time and billions of dollars worth of investments into the country. Why? As many say, it's because of recent geopolitical tensions, such as the trade war initiated under President Donald Trump, rising labor costs, and even the rise of alternative production hubs. One of these alternative hubs is China's neighbor, known as Vietnam. Vietnam has surprisingly stood out as a strong contender for many investors. It's got lower wages, a friendly foreign policy, and best of all, strategic location near major shipping lanes. Furthermore, Vietnam has done everything it can since the start of the 21st century to invest in infrastructure developments. Just take a look at their recent announcement of high-speed rail, which is expected to cost over $67 billion and will cut travel time from Hanoi to Ho Chi Minh City to just 5.5 hours, which is 6 times faster than conventional trains. The country's low wages is also one of its biggest attractions. Here's a graph on Vietnam's average wages by month since 2010, data that we collected from the General Statistics Office of Vietnam. As you can see, Vietnam's average wages has grown every single year, with the latest data available for the third quarter of 2024 showing 7.6 million dong per month in monthly wages, which is about $320, or nearly $3,900 per year. Comparatively, here's a graph on China's average yearly wages. Since 2012, China's average wages has nearly tripled, where in 2012, the average annual wages was just 47,000 Chinese yuan. But in the latest year available for 2023, it is now over 121,000 Chinese yuan. That is about $16,800, more than 4 times the average salary in Vietnam. Now, on top of infrastructure development and lower wages, it is also important to know the biggest factor here, which is geopolitical tensions. China and US tensions have continued to drop due to factors related to trade, Taiwan, and even the South China Sea. These geopolitical tensions have then brought some investors to think twice before investing in China. As a matter of fact, in recent times, President Joe Biden has even banned and limited key technologies that would be exported to China. In retaliation, China has done its own export limitations. What this means for foreign investors is that they might take into account the stability in relations before investing. We can see the diversification of US trade with China in this graph right here. As you can see, in this graph, data that we collected from the United States Census Bureau shows the top trading partner of the United States in 2018. As you can see, the top spot is no other than China. The total trade between China and the US was over $659 billion. For that year alone, this accounted for 15.7% of the US total trade with the rest of the world. Do mind that this was the very year that the trade war between the US and China began under Donald Trump. And if you take a closer look, you'll actually see that Vietnam is nowhere near the top 15 spot in the list. Yet, if we look at the latest year available in 2023, we get to see a widely different picture. As you can already tell from the graph, China is no longer the #1 trading partner of the United States. Its total trade value has also dropped from $659 billion in 2018 to just $572 billion in 2023. The percent of all trade is now just 14%, which isn't a big drop from 2018, but it still shows a gradual slowdown in total trade. Then, as you can also see, Vietnam has emerged as the 8th largest trading partner of the United States with over $109.1 billion in total trade, encompassing over 3% of all trade of the United States. This difference just means that the US is now buying and selling more goods and services with Vietnam and is trading less with China. But this doesn't really tell us whether investors are really leaving China for Vietnam, right? Well, here's a graph on the US direct investments abroad in Vietnam from 2009 to 2023. Data that we collected from the US Bureau of Economic Analysis. As you can see, in nearly every single year, the direct investments abroad has gradually increased, with the latest year amounting to $3.7 billion, which isn't really a big figure at all. Nevertheless, it has still grown since 2009. The next graph that we will see, however, can tell us whether US investors are actually leaving China. And a big hint that we will give already is that no, there are more investors coming in than out. Here's the graph for the US direct investments abroad in China. As you can see, from 2009 to 2023, US investments have grown massively from just $54 billion to over $126 billion by 2023. Even in the important years of 2018 and 2019, where the trade war between the two nations have gotten really bad, the investments kept pouring in. So this then can tell us that investors aren't really leaving China for Vietnam. Well, a lot of news reports do indicate that some investors are relocating to Vietnam from China. But while there might be a couple of companies, it's not as big as most people think. It's mostly done in hundreds of millions of dollars, or even just a few billion. As a matter of fact, one of the largest US-based investors in Vietnam is Intel. One of Intel's latest investments was announced in 2021, and it wasn't a big investment at all. It was only $475 million. Probably one of the most significant ones that we saw was Apple and its suppliers. Apple's major contract manufacturers, Foxconn, Luxshare, and Goatech, have all announced investments or expanded operations in Vietnam. For example, Foxconn invested around $270 million in Vietnam in 2021 to 2022, and more expansions were announced to assemble AirPods and potentially other products. This is a key part as to why Vietnam's total trade has been on the rise with the US, as they are now exporting goods from Apple to US consumers. But, again, this is still a small figure when we compare it to US investments in China. Another data that we can see just why investors aren't leaving China for Vietnam in flocks is in their foreign direct investments data. Here's a graph on the foreign direct investments, net inflows in the balance of payment, as published by the World Bank. This graph will show the total volume of capital investments from foreign entities into a country's industries, businesses, and infrastructure, which, as you can see, Vietnam's FDI has been on the rise, with the latest year available for 2023 showing that they received a net inflow of FDI of over $18.5 billion. Comparatively, here's where it gets interesting, and why it might be shocking. Here's the graph for China's net foreign direct investment inflows from the same source. As you can see, China's FDI inflows have dropped big and fast in the past year. In 2021, China's net FDI inflows was a massive $344 billion, which was nearly the size of Vietnam's GDP. Yet, by 2023, it has plummeted to $42.73 billion, the lowest level since the year 2000. But before you can conclude that investors are leaving China, it's also important to know that a part of this is a global shift in lower FDI levels. Here, if we add the FDI inflows for the entire world in 2023, we'll see that it's not just China that has seen a drop in FDI inflows, it's the entire world. In 2023, FDI inflows for the entire world was just $847 billion, which is a figure last seen since 2003. In other words, while some investors may have indeed been leaving China, or are investing less, as reported by many news articles, it's also partly because the world was slowing its FDI inflows for the entire year. Then, finally, let's see the exports of both nations. Exports are a great way to see just how strong a country is for foreign investors, and that's because exports reflect the demand for goods produced within a country. This includes Apple's products in Vietnam, Nike's products in Vietnam, and a long list of other products that Vietnam sells or exports to the world. Here's a graph on Vietnam's exports of goods and services, as published by the World Bank. As you can see, Vietnam's exports of goods and services have been on the rise, with the latest year available in 2022 showing exports of over $384 billion. This is driven by its many products, one of which is Samsung, a company that has always stood out for the country. Samsung was reported to have revenues of over $65 billion in Vietnam, with exports amounting to over $55.7 billion. This foreign investment made by Samsung is a crucial part of why Vietnam is becoming an alternative base to China. Then, if we take a look at China's exports, we'll see that the figure has increased, but had seen a contraction in 2023. Although, this is still a small drop, considering how big it rose from the past few years. Therefore, there is still strong demand for Chinese-made goods and services, and it is still a figure that far surpasses that of Vietnam. Now, before we end the video, it is important to know that there might be some changes in the future for foreign investors and buyers of Chinese goods. We just saw the recent US election conclude that Donald Trump will be coming for his second tenure in office. One of his promises was to bring additional tariffs on Chinese goods. If Trump does deliver on additional tariffs, that means there will be another decline in exports from China to the US, and may push some investors and buyers to countries like Vietnam.